Hello, and welcome to Speculating with Futures and Traditional Commodities with Noble Dracone. I am Noble Dracone, author of the books Futures for Small Speculators and Single Stock Futures for Small Speculators. I'm also an 11-year veteran of futures trading, both as an investor and as a broker. Currently, I'm senior analyst and senior trader at Liverpool Derivatives Group, where our goal is to bring security to speculative investing. Today, we will discuss futures in a way that is approachable. We will dissect futures and traditional commodities into bite-sized chunks that will let you trade futures with confidence, eliminating the demons of fear and greed. Let's begin. Now, the first thing I'd like to discuss is the risk involved with futures. Futures investing is not for everyone. Futures are very risky and they move quickly because of the leverage. So if you're not investing with risk capital, don't trade futures. You must only use risk capital, money that you can afford to lose, in order to invest with futures. And there are other things that deal with futures, such as past performance are not indicative of future results. So be very cautious when you read the risk disclosure. Now, this is a two-part series. This first part is called Getting Started with Traditional Commodities and Futures, and it will guide you through your investment as a new futures investor. Now, what we will cover will be fundamentals of futures investing, giving you the basic idea of where futures comes from, how they've been invested in, and what place they have. Then we'll cover the new single stock futures. Many of Pristine.com's current traders trade primarily stocks, and so it'd be good to see how your trading will be affected by this new investment vehicle. And lastly, we will cover the top 10 mistakes that new investors to futures make. This is a very important area, and definitely pay attention to it. Now, in the fundamentals of futures, we'll cover 5 specific areas. First, the origins of futures and where they began. Second, we'll define some terms that are particular to futures to help you better understand the language. You know, every investment or every new thing has its own special language. Third, we'll cover what current futures trading is like, and what's happening, and is it doing well, is it doing bad. We'll also cover the historical anecdotes about futures that have made futures over the years seem very risky to a lot of people, and we'll hopefully clear up some of the myths and misconceptions. And lastly, we'll just find out, is futures relevant for your portfolio today? Let's begin with origins. Now, futures have been traded all around the world, but some of the oldest futures investing occurred in the United Kingdom. Futures started back in 1571 at the Royal Exchange of England. At that time, merchant venturers who had invested in large ship cargoes from around the world put up a lot of money to buy cotton, spices from India, and they needed a place to go in order to trade, and the Royal Exchange provided that. There were two things that they were worried about. Number one was that the voyages that this cargo took so long. They were afraid that the prices that they were selling the goods at would go down in case someone else's ship came in before theirs. And the second problem was just the simple hazards of long voyages. At that time, cargo may take 6, 7, 8, maybe a year before it arrived. So they needed to figure out a way to lock in prices today and sell their goods in order to make some profits. And this is what they did. So they met in coffee houses and sold forward contracts to one another. And this is where the London Metal Exchange started, where many traders in gold and silver would sit and trade gold forward contracts and silver forward contracts and many other current investments. In the 19th century, the Exchange of London started to develop because of the industrial era and industrial revolution of textiles. In the United States, futures evolved from the need of Illinois grain dealers to protect themselves from various credit problems. With the growing grain development, corn and wheat in Chicago, many people who owned silos, the grain dealers, wanted to purchase these goods on credit. Unfortunately, lenders wouldn't allow them to purchase the goods on credit because no one knew where the prices were going to go. And so out of necessity, farmers and silo operators developed what were known as to-arrive contracts. These contracts became the standard way to trade the precursor to futures and allow grain operators and farmers to get credit and basically facilitate a trade. It was a great way. And what was important about these to-arrive contracts were three things. The first was they actually specified a future date when these items would arrive. So there was no uncertainty about that. Second, there was a specific quantity and amount. And most importantly, there was actually a price on these documents. And so banks felt more than comfortable lending on them because they knew when they would get paid back and how much the borrower would receive. And this was actually the precursor to what we now know as the Chicago Board of Trade, which was started in 1848. Now, futures is not only indicative to the Western world. We have to look at many other countries that have had to trade futures out of necessity to protect themselves. We can look at 17th century Japan. They started the first futures contract by most people's assessment in rice futures, which was very similar to today's futures. The funny thing about it is the rice futures of that time were known as rice tickets and were actually used as a type of currency for the day-to-day common people. It was very important to the economy. Next, we look at 18th century India. And in India, they needed to trade futures because they were starting to develop a strong cotton trade with the United Kingdom, and they needed to fix the prices on goods. So the first organized futures market in that country was the trade in cotton. It was followed by futures markets in oil seeds and food grains, but again, it was very important that farmers and purchasers had a handle on the prices. In 1920, Singapore started their own futures contract in rubbers. So the important thing is, and the reason why I bring up all these historical examples, is to let you know that futures is not alien to the investment world, and it's been around a long time, nor are they difficult to comprehend, which leads us into the concepts of futures defined. Now, as I said before, it's important to understand what futures investing entails. And one of the top priorities of futures investing is the futures contract. A futures contract is a binding agreement between a seller and a buyer to make or take delivery of the underlying commodity at a specified future date with an agreed upon payment term. And it's important to know this. There are two parties to every side, and that these are agreements, not actual ownership. Plus, futures and options are collectively known as derivatives. Derivatives are basically financial instruments in which there is an underlying real-world value. And these instruments are often traded hand-in-hand, whether futures or options on futures. But they're very important. It's very important to understand what future contracts are. Now let's define some of the terms that deal with futures and are peculiar to futures. First, we'll start with the cash spot market. Cash spot market deals with the physical commodity, which can actually be traded simultaneously with the futures contract. For instance, gold is traded around the world, bought and sold, simultaneously as the futures contracts are being traded. And so sometimes there's slight discrepancies in prices, but everything's happening simultaneously. Clearinghouse. This is a unique development solely for futures investing. Clearinghouses were designed to act as the counterparty to every trade, so that there will always be a buyer for every seller, and there will always be a seller for every buyer. Clearinghouses act as the counterparty, and they have set up a system in which they match all of the buying contracts with all the selling contracts at the end of the day, and they also are the ones who transfer the funds. Very unique to futures, but it also creates a high level of protection because you don't have to go out and find someone willing to buy your futures contract.